That IPO opens up on the 27th of October, and the company is looking to raise about 3,000 odd crores. Remember, IndiGo has great financials in terms of it being the largest domestic aviation company with a 33% market share, and it has been profitable for the last 7 years. However, just before the IPO, the company declared that in this first quarter they were negative net worth after being profitable for the last 7 fiscals. What's going wrong? Kapil Kaul, the CEO India Subcontinent at Center for Asia Pacific Aviation, joins us on the phone line, and Deven Choksey of KRChoksey Investment Managers, who's done a lot of number crunching on the IndiGo IPO, he joins in as well. Deven, I want to start off with you first. How worried should an investor be, an investor who's interested in the IndiGo IPO, how worried should he be about this negative net worth that the company has declared yesterday?
Yeah, good morning, Sonia. Well, I think on one side, I think one certainly would like to acknowledge that this is the most profitable airline and one among those in the LCC space in the global markets, where I think they've demonstrated a sustainability as far as I think the profitability is concerned. So certainly I think on that side, I think one would like to give good marks to the company. But on the other side, I think before the IPO, when I think your net worth turns negative, I think you start looking into the internals and you find I think some of the things. Of course, I think they distributed, I think, a large sum of money by way of dividend. But along with the dividend, what has also gone along with is, I think, the amount of money which they had taken the MAT credit, and also, I think, the dividend distribution tax, I think, which has ultimately, I think, gone out of the books. If you do the maths correctly, I think it has resulted into the amount of, I think, the negative net worth. Dividend is an earned profit which was in the reserves. I think it has gone out, that's okay. But I think the other money has also gone out, and that has resulted into the negative, I think, reserves, and they have dipped into the reserves because of that.
How much is the non-dividend amount that is gone from the balance sheet, Deven?
Lata, if I do, I think my maths clearly, I think out of total cumulative profit of 3,914 crores, total amount of dividend paid is 3,700 crores. Oh. And if you look at, I think, the MAT credit, and if you normalize this profit of 3,914 crores, I think it turns out to be 3,441 crores to be very precise. So it ultimately, I think the difference is 260 crores, which has gone, I think, more from the reserve itself. And if you add up to, I think, the tax component on the dividend, which is about 420 odd crores, I think then it sums up to somewhere around 680 crores, I think, which has gone out of the books of the company.
But will this practice in any way be construed as bad corporate governance, Deven, or in a way, is it a good thing that the company is rewarding its shareholders with the higher dividends?
Well, on one side, I would certainly like to believe that I think rewarding shareholders with the dividend, I think, is a good practice. However, I think at the same time, I would like to put across that I think coming before the IPO, and I think at that point of time, if we are getting into this situation, I think it somewhere, I think, raises the doubt. Of course, I think the company can well argue, and I would like to listen to their argument, that they would have the operational profits to take care of the reserves which would get eventually built up, in which I do believe that I think operationally, if they remain efficient, I think certainly in this year they will have profits to talk about. Along with that, the fresh issue of shares and the premium that they would be adding into, I think certainly it would build part of the reserves for sure. But I think the point is that after listing also, I think if this dividend practices continues, and I think if the shareholders who have come new, if they also start enjoying this kind of a high dividend into the company, then certainly I think I would call it as a consistent track record. Otherwise, if it is getting disrupted, then we'll have to have a question mark on the subject.
But the promoter stake post-IPO is also 82%. They really can have their way, can't they?
They can have it, I think, for sure. And I think given the fact that I think they reduced the size offer for sale, I think by 3% yesterday night, I think probably I think it is still now hit at around 85%. So certainly I think they would have their way to distribute higher amount of dividend, and I think reward the shareholder and themselves also eventually in future. Nothing wrong with that policy on dividend aspect as far as I am concerned, as long as I think it remains consistent, I think, throughout.
Okay. Well, Kapil Kaul, the CEO India Subcontinent at Center for Asia Pacific Aviation, joins us on the phone line. Kapil, as an investor and as an expert, how would you react to this dividend policy of the promoters of IndiGo?
Well, Lata, I think it's a debatable sort of a discussion, in the sense that there would be arguments towards the fact that just prior to the IPO that dividends have been taken to the amount that IndiGo promoters have got. It reflects some kind of could reflect some kind of an issues with the prospective investors. But by and large, I think they had a very consistent dividend policy right from the time they've been profitable. 70-80% of the profits are going primarily back to promoters. So I think if the fact that they are aware of they were aware of these issues would be raised once they hit the IPO, and it reflects their confidence that going forward, I think the sharing of dividends would continue, not only for the existing promoters, for the new shareholders as well, and I think that's positive. I think we need to take a call on their dividend policy post, say for example, FY16 when they declared their dividends for this fiscal, and if there is a change in dividend policy, then perhaps one could raise an argument. I think as of now, I think they have taken this call. I think they reflect their confidence, I would think. And I think probably after the dividend policy is announced, once they declare the results, if there is any change in the dividend policy, one can basically take a call on right now. I think the company's IPO is very strong. The management is very confident of their future, and I think the profitability for this fiscal is going to be another 200 million plus. So I think it's a good story so far, and as long as they can share this dividend with investors, I think it will be positive for everyone. And one has to wait and watch as to how the dividend policy will be post-listing. But if they continue to reward the investors favorably as they have done till date, I think it will be good for the new investors who come on board.
All right, Kapil, Deven, just stay on. We have a couple of more questions with regards to whether investors should subscribe to the IPO. All that and more after a short break. Stay tuned.
Express headlines of the hour.
For Center for Asia Pacific Aviation and Deven Choksey talking about that high-profile IndiGo IPO that will be launched on the 27th of October. Deven, I wanted you to comment on the point that Kapil was making about this IPO being very strong, and the fact of the matter is that the company itself has been reporting almost a 40% CAGR in revenues since FY11. Given that the credentials, we'll try and establish our connection with Deven in just a bit. But Kapil, same question to you. Given that the credentials of the company are so strong, would you recommend investors to go ahead with this IPO?
Lata, I think one of the things that I may like to say to you, that just to give you some figures which basically would reflect on the strong fundamentals of this company. Two factors to me are very critical. One is the rate of return on capital employed and the revenue growth that the company has delivered. If you look at the return on capital employed over the last 5 years, it's over 30%, 30.6% to be precise. And you talked about the revenue growth. The revenue growth is roughly about 43% in the last 7 years. And that's phenomenal. For an Indian market where promoters put in 30 million and roughly take 600 million out in 7 years, is phenomenal, where others have lost about over $10 billion. So it's a phenomenal story, frankly, as IndiGo points out to be that it's no longer a competitive difference, it's a structural difference. Their business model is basically now has a structural difference compared to the other players. So I think fundamentals are very strong, and I'd like to point a couple of things where I believe the revenue upside is going to be significant going forward, because starting from maybe 2016, they will add almost 50 to 60 planes. And most of these aircraft are going to be 15% fuel efficient. So you're going to be a market share of 50%, and the new aircraft will bring you a cost advantage of about 15% compared to your other players. And a 50% market share in a market like India, where potentially from a 70 million target you're going to go to 218 million in 10 years. I think there's a huge upside for growth. Internally, if they can continue this momentum, I don't see an external issue. I don't see anyone ahead of IndiGo or competing with IndiGo in the next 5 years. Their problems are internal. Can they keep the same momentum? Can they make sure that they create a more stronger institutional framework? Then they create less dependence on few people and move it deeper down at the institutional level right across the organization? Can they keep the level of sort of entrepreneurship that exists at IndiGo at the same level? I think the challenges are internal. If they can control the internal challenges and maintain this momentum, I think going forward there's a massive upside for IndiGo.
Okay, well, Deven, actually same question to you. Would you recommend a buy? And my caveat is that, you know, the issue is coming at a time when it is unusually favorable in terms of fuel prices for airline companies. I mean, if you took a 10-year average, this is the best time. So are we buying the stock at its height? Deven?
Yeah, Lata, sorry, in between the voice got lost. In
Okay.
between, I think.
Now, is it a buy, and are we buying it expensive because?
Price,
Yeah. Yes, yes.
All right. I think the important aspect is about, I think, the valuation at which I think the company is being marketed. Yes, I think on the fundamental side, I think the company has produced, I think, relatively better numbers as far as I think the return on capital employed is concerned, and they've been consistent with it. However, I think when you look at EV to EBITDA, the ratio is basically aggressively positioned at around 8 to 8.25 times, as against other successful carriers in the global market like Ryanair or the Southwest Airlines, I think, which have been, I think, quoting at 5 to 6 times EV to EBITDA. However, I attribute this particular aggressive valuation also due to the fact that I think in Indian markets you don't have too many comparable choices available as far as I think the investment objective is concerned in this particular space, and that's where I think the higher amount of premium is to a greater extent justified. I would think that I think yes, currently the fuel oil prices are low, and that forms a substantial part of the ATF, I think, as we call it, I think, which is 52% kind of a cost involved into the operation. As long as I think the fuel prices are low, certainly I think this particular business would have the wind power to, I think, sustain further amount of profitability. So maybe I think one will have to remain watchful, but at the same time I think one could probably argue for it that yes, I think given the choice availability into the market, one could possibly consider this particular stock into the portfolio.
All right. Deven, Kapil, thank you very much for joining us in this discussion. So, well, despite what we heard in terms of a dividend payout, largely the opinion seems to be in favor of that stock. In fact, Aditya Ghosh himself answered some of these questions yesterday to our correspondent Farah Bukwala Borao, who caught up with him. So let's hear out a little bit of that conversation.
Actually, there isn't very much need for the cash in the business. We are profitable, we're cash generating. But you know, Farah, we're 9 years old now. We're not a baby airline anymore. With the established carrier, we have 36-37% of the Indian market. So I think in any organization, you know, there is a certain milestone that you have to come to where it creates that legitimacy, if you will. It creates that, you know, bigger, as you said, brand and so on and so forth. It's not just brand, but it improves your credit rating when we are going on leasing airplanes, when we are going and getting debt financing. So that helps. So that's one. The other piece is that, you know, IndiGo has a unique problem, and in some ways it is a problem, that we are the market leader, we have hardly any competition, we're competing against ourselves every day. Okay. And for me and the management team, that rigor that comes in, irrespective of what we try internally today, that rigor that comes in from being a listed company is incomparable. Okay. And that creates that much more pressure, that much more of focus in trying to stick with between the straight and narrow and make sure that we come out way ahead in terms of any corporate governance you know, parameters.
You know, but if one were to look at your valuation today, you're almost setting yourself on the likes, or you're benchmarking yourself on the likes of some companies that have been established for over 100 years today. Why the need to so aggressively price your IPO? And what are your estimates as far as your future earnings go that can support such a high valuation?
So actually, I don't think it's a high valuation at all. It's a very reasonable valuation because we are not comparing ourselves to 100-year-old companies. We're only comparing ourselves to the best in the low-cost field. Wizz Air, Ryanair, EasyJet, you know. And these are companies which are 10, 15 years old, some even lower. They're in the same business that we are in. And the valuation is nowhere close to what those companies are at. It's only the multiple. And look at the growth story that IndiGo has because of the fact that we're in India. We have found a unique way that not only have we created a 7-year track record of profitability, over the last several years we have kept our cost in US dollars somewhat flattish, and with the NEOs coming in, which are going to attack 10 to 15% of our fuel, we've actually finally found a way that not only is there growth, but actually cost structure comes down, which is not happening in any of these other airlines, because the planes are already sold out. We had the forethought and the timing to order these 480 airplanes back in 2011, then order the next 250 airplanes in 2015. So the 180 and 250 put together, we have 430 more airplanes on order. These airplanes are backlogged. Nobody else can get access to these airplanes. And as we replace the current airplanes with the newer airplanes, over a period of 6 years, we actually completely flip out, and we take the lowest cost structure in the world, even lower.
Sure.
So that is really what sets us completely apart, of course, from Indian carriers, but leave them aside, actually sets us apart in a business model vis-a-vis any of these global carriers.
All right, so that was the argument in terms of cost and revenues coming from Aditya Ghosh.
I just want to make one point before we wrap up, Lata. You know, the point that Deven was making is that some of the bankers should have taken this into perspective. The fact that the company has chosen to pay a dividend rather than building its own reserves or lowering its debt of 4,000 crores, that should have been baked into the price as well. The price should not have been as aggressive as it is currently.
Well, to be fair, the subscribers are going to pass the verdict on whether they think it is overpriced after the dividend has been squeezed out, or whether they think that that dividend policy is exactly why they will go and buy, because in future they could be rewarded if this is the dividend policy. That's for really the subscriber, the buyer, to take a call on. Well, with that, let's shift focus to another theme that we should be discussing, the global risk on that came in for emerging markets and the fund flows that we saw over the past 2 weeks after almost a 13-week gap. Ian Hui, the global market strategist at JP Morgan Asset Management Company, joins us on the phone line.